Are you considering buying an investment property in Sydney right now? If you are, then stop, because this video is for you. Hi, my name's Niro Thambi-Pillay from Investment Rise, and I'm someone over the last 5 years alone who've helped my clients invest in over $50 million worth of investment property. And today I'm here to give you the 5 reasons why you should not look to invest in property in Sydney right now. Now, I know that might seem strange because Sydney is our biggest capital city. It's our most populated city, and we've got a growing population. So why shouldn't you invest in Sydney right now? Well, let me give you the 5 reasons. Number 1, the Sydney market is already in a slight downturn. Now, I'm not talking about a massive crash like these so-called American doomsday experts. That's not what we're talking about. But there is a flatlining in some areas, and other areas are going slightly backwards. Depending on which report you read from someone like Residex or CoreLogic, you'll see downturns of 1.5%, 2%. Nothing major, but not really a market you want to be entering in right now. So we're in a slight downturn. Number 2, our rental returns in Sydney are shocking, which means the negative cash flow you experience when you buy an investment property is going to hurt your bottom line, because the rent plus any tax rebates you're going to get, it's highly, highly unlikely that you're going to have any chance of that income covering your costs. So therefore, you're going to have to use your hard-earned money, your savings, to top up your investment property, which means it's going to either affect your lifestyle, it's going to affect your future borrowing capacity if you want to get a larger portfolio, and it's just going to not feel right. And you're going to pay all this money, and if you're in a market that's going slightly backwards, you're losing both ways. So again, the cash flow in Sydney property hurts. Don't go anywhere near it. Number 3, our vacancy rate in Sydney is on the rise as well. So not only are we in a slight downturn, not only is the cash flow going to hurt you, but there's going to be times when you're going to either have to accept a much lower rent, or you're going to have vacancy, which means you're now going to have to fund this investment property on your own. And if you've got your own mortgage on your home, you're now going to literally end up funding 2 mortgages. So with the vacancy rate on the rise due to the massive oversupply we're going to have over the next, I would expect, 3 to 5 years, owning a property, especially entering the Sydney market right now, it's a dangerous thing to be doing. But that's not all. Number 4, if you think, okay, I'm going to stay away from apartments, which I think is a very good idea at the moment in Sydney, let's go invest in a house. Well, your rental return is hopeless, but more important, your land tax threshold in Sydney stings. So it's one of those hidden costs that people don't tell you about. In Sydney and New South Wales at the moment, the land tax threshold is around about $407,000 for a couple. Now you tell me, if you're going to buy any kind of decent house in Sydney, where are you going to buy a house where your land value is less than $407,000, unless you're buying a little postage stamp? You're not, right? If you buy an average house in Sydney, which is about $1 million, your land value is going to be somewhere around $650,000, $700,000 at the lower end, which means you're going to pay land tax on around about $300,000. And that's a cost that's not tax deductible. It's going to come as a one-off bill for you towards the end of the year, and it's going to hurt you. So again, the land tax threshold really stings in New South Wales. And the final 5th reason, banks. The banks, the people who control the money, they're saying they'd rather not be lending on property, on investment property in Sydney. I recently went to a meeting of the banks, and they were all saying, look, if you can bring us loans on houses that are sort of outside of Sydney, especially those apartment-centric areas of Sydney, we'd really appreciate it, because they've got such an overexposure in Sydney at the moment because of the massive boom we've had over the last 3 years, that they're trying to spread their portfolio. So they're literally staying away from certain pockets of Sydney. And if you don't know what these pockets are, you could easily get burnt. But more importantly, if the banks are saying, hey, maybe you should reconsider and stay away from Sydney, maybe that's advice worth listening to. So definitely for Sydney right now, not the area to be investing in. But does that mean you should invest at all? No. There are some great opportunities out there for areas that are really expected to grow. In fact, have already started their next growth cycle. Remember, not Sydney, rather, but Australia is an area of multiple markets. So just because one area is going flat doesn't mean that all areas are going flat. In fact, from 2012 to 2015, while Sydney prices were going through the roof, Perth, for instance, was as flat as a pancake. Now, I'm not saying you invest in Perth right now, but what I am saying is that as Sydney tapers off from its great growth and it starts to go backwards a bit, there are some great opportunities out there. And what I really encourage you to do is work with someone who's got the experience to be able to guide you and show you these opportunities so then you can make an informed investment decision. I really hope this has helped. Let me know if you've got any questions in the comment field below. Bye for now.